$38 trillion of debt, a deficit that is running at $1.8 trillion a year. And just the interest service on our debt is $1.2 trillion a year, the second largest spending category. We should not be satisfied with 2% real GDP growth. Europe is very pleased to get 1%, and Japan, anything between 0 and 1. So we get used to having this very low growth rate compared to history, and I think that we need to be more ambitious.
Coming months, we're maybe even taking in some of the revenue from tariffs.
Tariffs.
So is that something that you think positively about when we actually do tariffs?
The media generally looks at the tariff situation and certain politicians in the wrong light. There's another reason to have tariffs, and that is...
What are the growth opportunities for 2026? Is it AI?
AI affects every single industry. So this is a technology that can lead to vast productivity gains. And we have not seen it yet. Just wait. It is the tip of the iceberg that we're seeing right now.
It seems like every survey that comes out from consumers is their number one fear in retirement is outliving their money.
Like at some point, you need to think about a dynamic strategy. And that's exactly what we've designed, research affiliates in partnership with Goldman Sachs.
An advisor who might be listening to this, is there a more efficient way?
Yeah, so great question.
Systems work, people fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
Welcome back to this week's episode of the Advisor Mentorship Podcast. I'm your host, Jeremy Hauser, and as we kick off 2026, I know we've had some legends out there in the economic markets over the years. Last year, we kicked off 2025 with none other than Professor Jeremy Siegel, and this year, very happy to bring our guest and honored to bring on Cam Harvey. And for those that may not know that listen to the show, Cam Harvey received his PhD from the University of Chicago. He was also the first person to write about inverted yield curve back in 1986 and is currently a partner at Research Affiliates, serving as director of research and is an active professor at Duke. How are we doing today, Cam?
I'm doing well. Thank you for inviting me.
Well, thanks for coming on, obviously. Very gracious of your time. And I believe, so before we dive into some of the questions, so Professor at Duke, how long have you been doing that?
A long time, since my dissertation in 1986. So I've been to other universities, but I decided to stay at Duke for the long term.
I love that. And so as you peel back, looking at 2025 and forward looking into 2026, so moving forward, what would be the most critical economic or physical initiative for this administration and Congress as we look for hopefully another sustainable growth in 2026?
Well, the key word is growth, and that's what we need. So if you think of our fiscal situation, it's not good. $38 trillion of debt, a deficit that is running at $1.8 trillion a year. And just the interest service on our debt is $1.2 trillion a year, the second largest spending category. Indeed, we spend far more paying interest than we spend on national defense. And that's highly, highly unusual. So the key thing for me is to put our fiscal house in order somehow. And there's not that many alternatives, and some of them are not very attractive. So, for example, we could raise taxes and pay down some of that debt and reduce the deficit. But we know taxes are toxic for economic growth. And no politician even wants to use the word tax. So that's off the table. The second alternative is to pay off some of this debt by printing money. And indeed, the US could do that because more than half of the debt is owned by non-US persons and institutions. So effectively, what you do is expropriate from these international investors. You pay down the debt, but we know what would happen. You print the money, that would spark another even more serious wave of inflation. And inflation is like a tax. And indeed, the last election, I believe the Democrats largely lost that election because of the inflation pressure that their policies contributed to. So forget number two alternative, which is to print money. Number three is to grow. So we've gone through this long period of very lethargic growth. So when you grow, even if the tax rate is the same, the revenues increase. So what I think should happen is we should refocus on growth. We should not be satisfied with 2% real GDP growth. Europe is very pleased to get 1%, and Japan, anything between 0 and 1. So we get used to having this very low growth rate compared to history. And I think that we need to be more ambitious. And the focus should be on doing whatever is possible to maximize the rate of growth. We have had 4 or 5% growth in the past. That should be our focus. That is the way to deal with the debt situation, the deficit, the changing demographics. It should be growth. And there should be less focus on these things that we can't afford. So yes, it's a nice idea to have a savings account for children, but we need to borrow to do that. We can't afford to do this stuff when you've got a $1.8 trillion deficit. So we need to focus on growth.
And I know last year, a lot more talks about it, and here it seems over the coming months, we're maybe even taking in some of the revenue from tariffs. So is that something that you think positively about when we actually do tariffs to try to incorporate and bring in more growth domestically?
Tariffs are a tax. And we know that taxes are negative for economic growth. So tariffs actually go in the other direction. And there's widespread agreement amongst economists that tariffs are just taxes on the consumer. In terms of what revenue the tariffs bring in, and I've heard this story before, oh, we'll get all this revenue and we can invest in growth. I'm afraid not. So if you look at the revenue from tariffs, maybe it's $400 billion, maybe. And just let me remind you, the deficit is $1.8 trillion. So what does this lead to? It leads to a minor reduction in the deficit. This isn't money that's on the table to spend on growth initiatives. The first thing we need to do is to reduce the deficit. And if we can do that and ideally turn it into a surplus, then we can begin to pay down our debt. So tariffs, again, are a tax. Now, I think that the media generally looks at the tariff situation and certain politicians in the wrong light. There's another reason to have tariffs, and that is to repatriate manufacturing. So if you look at 2004, let's say, so that's like 22 years ago. In 2004, the US manufacturing output was double that of China. Fast forward 20 years, and the latest data we have is 2024. China was producing far more than the US in manufacturing, more than 50% more. So it's almost a complete turnaround. And strategically, that puts the US at a disadvantage. We know that in any conflict, in the last 100 years at least, equipment is really important. And manufacturing is important for that equipment. And indeed, you don't need to go back to World War II. Just look at what's happening in Ukraine today. So you need a strong manufacturing base to be competitive in a conflict and to deter a conflict. And again, China's manufacturing much greater than the US. And let me just give you one example that I think is underappreciated. So we hear all the time about China's dominance in rare earths.
Mm-hmm.
Well, what about something that is strategically important that we use every day, and that's aluminum? So most people don't know this. And we know aluminum is crucial for the manufacturing of military equipment, in particular aircraft. So China is the largest producer of aluminum in the world. Indeed, it produces 60% of the world's aluminum. The question is, well, how much does the US produce? Obviously less. It produces less than 1%.
Wow.
So that is unacceptable in terms of geopolitical risk management. So I think the other way to look at tariffs is that for us to remain strong geopolitically, we need to repatriate some of the manufacturing. Is that going to be expensive? Yes. Are tariffs good for economic growth? No. Think of tariffs as a means to increase the manufacturing capacity, to plug this hole that is very serious, and it comes with a cost. It's like an insurance premium. It's annoying that we have to pay the premium when we might not use the insurance policy, but it's insurance, and it's something that has to be done. Unfortunately, given the fiscal mess that we're in, we don't have a lot of flexibility. So I think that's the correct way to look at tariffs, that it is a matter of national risk management. And let me also say that 2025 was pretty chaotic in terms of the tariff policy. I expect in 2026 that the policy will be much more focused and strategic.
Are you an advisor that happens to be a business owner? Advisors come to a point where they work in their business instead of on their business. And as entrepreneurial advisors are looking for systems and resources to plug into, it can be hard to take on this task alone and can also be very, very expensive. How can you get institutional resources and still remain independent? Check out our one pager, which is titled AMP Path to Prosperity. This is a quick one pager that gives you really a checklist over a couple of items that are helping independent entrepreneurial advisors really build, scale, and capitalize on their business. Make sure to go to www.insuremarkamp.com/jhauser. Click on Learn More and request your copy of the AMP Path to Prosperity for this checklist today. And for those that have been following you, I mean, multi-asset, I mean, literally multifaceted assets, you're all across the board. You've actually written numerous papers on different asset classes. I think one of the more recent ones you wrote about Bitcoin and gold, I believe, just a couple months ago. And so as you build up and look into 2026, so where do you see, based off of the asset classes, where's momentum being built going into next year and this year?
Let's tackle a few assets. And let's obviously start with equity. So people very concerned about the concentration in the gains with the stocks that are linked to AI. And there's much talk in the media about bubbles and whether this is just like 1999. So 2026 is the new 1999. And I think that this is highly simplified and misleading. So let me tell you the differences from the way I see it between 1999 and 2026. So first, number one, there's a key technological difference between what we can do with AI and the introduction of the internet. So the internet was a technology that gathered information and a great innovation that had been around for since the late 1970s, actually. But it was widespread in its adoption in the 1990s. And some companies had great benefit from the internet, but this was mainly a way to extract information efficiently and also very good for socialization. AI is fundamentally different. So AI has the ability not just to gather the information, but to solve the problem. So what we're dealing with is a technology that is creative. And this is fundamentally different between the internet innovation and what we're experiencing today. Even though people like to equate the two innovations, no, they're much different. And number two, kind of related to what I'm saying, that in 1999, some industries benefited from the introduction of the internet. Some industries, it's in the background, not really that big of a deal. Whereas AI affects every single industry. So this is a technology that can lead to vast productivity gains. And we have not seen it yet. And people want to judge it and say, oh, well, the productivity gains are not that great. We're not seeing it. We're not seeing it. Just wait. It is the tip of the iceberg that we're seeing right now. So this is different in terms of the diversity of applications across all industries. So that's a fundamental difference also. Number three, the leading firms have a propensity to self-disrupt. And let me unpack what I mean there. So back in 1990s, these companies taking undiversified bets on particular technologies. Whereas today, the leading companies, they have no problem in doing something that would potentially lead to lower profits for their existing business. So this is sometimes called the innovator's dilemma, where the innovator's got this great technology, is making a lot of money, and then they're asked to spend a lot of money to disrupt all of those profits. And it's really hard to do. The leading companies today are more than willing to do that. So you think of, for example, Tesla. So people mistakenly believe that Tesla is an automobile company. That is not their strategy. So they've got a long-term strategy to be a robot company. And the car is just one incarnation of a robot. So self-disruption, that's really important because it gets you to a state where you're resilient. Because things change very quickly, these firms can pivot and are pivoting all the time. So number four, many of the founders and leaders of today's AI wave of technological innovation remember 1999. So this is really important. In 1999, we didn't have any leaders that remembered or lived through 1929. So this is a quarter of a century. It is kind of a fresh memory. And then number 5, if you look at the dynamics of the fundamentals, it is different. So in 1999, the price earnings ratios were going up like crazy, but it was because the price was going up, not the earnings. So if you look at the fundamentals today, it is not just the price going up, but the earnings are also going up. So I think that's a fundamental difference also. So in the end, do I believe that there will be a correction? Yes. So many of these firms are valued so that they're all going to win, and we know that's not going to be the case. Do I believe it's going to be a serious correction? No. And this talk of bubble, I think, is greatly exaggerated. It's overstated. It's a popular story. It's eye-catching.
Mm-hmm.
But when you actually analyze this, it's much more subtle, and it's important to look at the differences as well as the similarities. So I am positive on equity, but I also believe that you need to be smart in the way that you deal with these growth stocks. And indeed, this is something I've been working on with research affiliates and Goldman Sachs, a way to capture these growth opportunities in a dynamic way.
Ibexis is committed to delivering smart solutions that help you win more business. Starting January 1st, 2026, the Ibexis Wealth Defender Bonus and Wealth Defender Bonus Plus will deliver even more value with a 1% increase in premium bonuses for issue ages 71 to 75. This enhancement further strengthens Wealth Defender's position as a powerful accumulation focused FIA, offering 3 product variations, guaranteed par rates, or premium bonuses and bonus options with or without a charge, including up to a 22.5% premium bonus on a 10-year contract. Add in an additional activities of daily living feature based on full contract value, all from an A- rated carrier on a 100% digital platform, and you have a compelling solution for today's clients. For more information, feel free to go to www.insuremarkamp.com/jhauser and click on Learn More. That's an incredible. It's like you really think about it and you look back to just Amazon in general, right? Just Amazon decades before as a book company. And here they are as they continue to manifest to who they are today. Um, Interesting with Tesla.
Constantly pivoting. Indeed, Amazon began as a rare book company. It's not that well known,
Mhm.
but they are constantly pivoting. They spend a massive amount on research and development. Indeed, they spend more on R&D than some major countries in Europe, like France or Italy. So they're spending for the long term. They're constantly pivoting, and this again provides some internal diversification. They're ready for the next big thing.
Yeah, absolutely. With the research that you've been doing with your team at Research Affiliates, so how do you define growth, or where are the growth opportunities? If we were to just say in the shorter term for 2026, is it AI or is it something else?
Yeah, so let me explain what we've done in terms of uh, how we think about equity.
Hmm.
And indeed, we package this together in a fixed index annuity product. And let me explain the equity leg. So, most people don't realize that if you have a portfolio that is 50%, let's say Russell 1000 value, and 50% Russell 1000 growth, so an equal portion in value and growth, that portfolio delivers the Russell 1000. So what that means is what's not in the value bucket is in the growth bucket. So we start with a very simple intuition. And that intuition is, why would any investor hold expensive, low growth stocks? It's really hard. You ask investors, well, why would you hold a stock that's premium priced, but it's got low growth? Well, it's really hard to justify. So the first thing that we do is we exclude those stocks. So it's a very simple filter. So what we put in the value category are stocks that are inexpensive. And what we put in the growth category are stocks that have very good growth prospects. So think of growth as spending on R&D, sales growth, profitability growth. These are key things that should characterize a growth stock, not that the stock is just expensive. So that's what we start with. So we've got metrics for value that are based upon value, and metrics for sales growth and profitability and R&D for the growth bucket. So we've got two indices, one for value and one for growth, and they exclude these expensive low growth stocks. So just putting those together, if you do the 50-50 of these two, then you get something that's much different than a cap-weighted portfolio like the S&P 500 or the Russell 1000. You get something different and better, at least looking at the historical data. But we don't stop there. So we know historically that there are long periods where value outperforms growth or when value underperforms growth. So what we layer on is technology that I recently published in a top academic journal that allows us to switch. And think of it as we're aiming to be 100% in value when value is outperforming, and then 100% in growth when growth is outperforming. And if it's unclear, we do the 50-50. And we know the 50-50 is really good compared to just, let's say, holding the Russell 1000. So it allows investors to capitalize on these long periods where one style outperforms the other. And indeed, we've seen this recently with value underperforming for like 13 years. Like at some point, you need to think about a dynamic strategy. And that's exactly what we've designed, research affiliates in partnership with Goldman Sachs, and put this into this fixed index annuity. So I'm very excited about that. The annuity's got other aspects to it in terms of other assets like fixed income, commodities. We want some sort of defensive portfolio also. But the essence of the equity part is to take advantage of growth investing when growth is outperforming value.
Welcome to the revolution, where annuities move at the speed of opportunity. At Revel One Financial, they have unleashed the cheetah spirit with the direct growth MIGA, and it's now available in the state of California. Give your clients guaranteed growth and stability with one of the most competitive fixed rates in the market. 5.85% guaranteed fixed interest rate on the base 5-year direct growth MIGA, and 5.75% guaranteed fixed interest rate on the base product in California, which includes a death benefit. Plus, enhanced flexibility with an optional free partial surrender rider, giving clients access to a portion of funds when needed. Rider election will reduce the guaranteed fixed rate. Rates are subject to change at any time. Ready to grow faster with nimble, forward-thinking partners? Visit revel1financial.com or call 1-800-579-9875 to learn more. Revel One Financial, built to help unleash your cheetah spirit. Just listening to you talk about that, and I mean, I'm in my 30s, and especially with uncertainties, we got 3 years of domestically doing really well on paper. Seems like we've done exceptionally well with growth. And based off your research, the fact that there's alternatives out there where people can look at, such as like a fixed index annuity, to just have downside protection with upside opportunity. So with y'all's research, so why fixed index annuities? Is that a component to that?
Yeah.
Or what's the big component of why diving into FIAs?
So FIA is important. It's got a very interesting uh, characteristic. And this is something that I've studied for many years. Indeed, the foundational work in portfolio management looked at a very narrow definition of risk, and that's volatility. So the idea is you optimize your portfolio at a particular level of volatility. You try to get the best possible return out of that. And I published a paper in the Journal of Finance that deepened the definition of risk. So investors have a strong preference for a big upside and a strong aversion to the downside. So it's asymmetric. And what an annuity actually does is it tilts the portfolio towards the upside. So if you think about it with the FIA, the downside's limited to a zero return, and the upside can be very substantial. So this is something that you can put in your portfolio that has got limited downside risk. And in a diversified portfolio, you want diversification, and this provides the type of diversification that is the most important, in my opinion, in that it clips the downside.
And especially today, over the years now, the number one, it seems like every survey that comes out from consumers is their number one fear in retirement is outliving their money. But from what I'm hearing from you, which is true, but what I'm hearing from you is yes, there's components within annuities of why people over the last several decades have purchased these type of products. It seems like you guys are looking at it more as that alternative asset class because of the reasons you just stated, as opposed to more so just the income stories there for some of these opportunities within products. But you guys are seeing this as more of like, no, to generate some growth and value, you're able to utilize this alternative, essentially. Am I hearing you correctly on that?
You are. However, I will say that there are other benefits that you just mentioned to investing in an annuity. So I think that you need to look at overall all of the characteristics.
Mhm.
And of course, I am not saying that 100% of your portfolio should be just focused on annuity. It is part of a diversified approach, and it is an important part. And again, my research indicates that this fulfills something that's important for a portfolio, and that is limiting the downside exposure. So that's an important and I believe overlooked characteristic, given that we usually just focus on the volatility of the portfolio in terms of the risk.
Athene and Ibexis are thrilled to unveil the all-new index lineup for the Athene BCA 2.0 fixed index annuity. This powerful FIA features indexes developed by leading academic minds, including Jeremy Siegel, Robert Schiller, Ronnie Sacca, and Cam Harvey, creator of the Harvey Goldman Sachs RAFI Index. When you combine these economist-driven strategies with the innovative stable benchmark S&P 500 distance stabilizer, you get a formula built for strong, consistent performance. Performance matters. Discover why Athene generated more than $35 billion in fixed annuity sales last year by visiting www.insuremarkamp.com/jhauser and click on Learn More. Athene, driven to do more. It's interesting because a lot of the advisors, so registered investment advisors, fiduciaries that our team has communicated with for years now, um, it's fascinating because it seems like academia too is starting to really dive into this conversation for fixed index annuities. I know Roger Ibbotson wrote a white paper and can't believe it. You look up and it was 9 years ago when he put together a fascinating report that just talked about a bond alternative considering fixed index annuities. And that paper looked back 80 some odd years. Has y'all's team ever considered looking into putting together some of the data and research, or is that something that could be something your team's going to start looking into?
So at Research Affiliates, we've got all that data, and we're constantly looking at innovation, and we really focus on filling the gaps.
Mm-hmm.
So I described one gap where the standard approach to kind of value and growth investing leads you to a situation where investors hold these expensive low growth stocks. And indeed, if you think about the amount of passive investing today, so it's now the case that there's more money in passive than in active investing. So think of that passive portfolio. That passive portfolio is usually market cap weighted. And that passive portfolio has got the stocks that I've emphasized should not be in the investor's portfolio. That passive portfolio has expensive low growth stocks and is really hard to justify holding them, but people just buy passive because it's easy and low fees. So I think investors can do better than passive. Indeed, if you think about passive in general, if you think of market cap weighted portfolio,
Mm-hmm.
so the US is the most efficient market in the world, but it's not perfectly efficient. And what I mean by that is stocks are not priced exactly at the true price at every single point in time. So if you capitalization weight, and this is 100% mechanical, you will over allocate to overvalued stocks and under allocate to undervalued stocks. And it doesn't matter if you can identify what stocks are overvalued or undervalued. This just mechanically puts a drag on the portfolio. And of course, a good example of potentially overvalued stocks are these really super expensive low growth stocks. Like I can justify expensive if there's high growth opportunities, but it's really hard to justify expensive when there's low growth. So just a simple step like expunging these stocks that are expensive and low growth, that alone does far better than some passive market cap weighted portfolio. And indeed, we demonstrate this in our research, a recent paper called Fundamental Growth. And you can see the impact. So simple things are possible to enhance the investor's performance. So for example, instead of just blindly buying a capitalization weighted index, why not trim out the expensive low growth stocks? And indeed, that's exactly what our FIA does.
And I mean, you think of it in all the 40 plus years now of research that you've put together, and the fact of you believing strongly and willing to put your name into a space like this really shows that there's some pretty good, I would say, opportunity for 2026 and on within the FIA space in general. Um, so, I mean, that must have been pretty hard to think, right? I don't think not many people would to put your name behind a specific index or in an industry like that. Was that challenging to want to do that?
Yeah. So this is an opportunity that I never anticipated when I started out as an academic, to have my name on a product. And I don't lightly give over my name. So I am very enthusiastic about it because this product is based on my research. So my research on risk preferences, my research on the inverted yield curve, my research on dynamic strategies for commodities, and my research on fundamental growth and this mechanism that I described where we're switching between value and growth or 50-50, that is based upon my research. So if I'm going to publish the research,
Hmm.
I believe it's reasonable, not just to check the box as an academic that, oh, well, I get published. These ideas have practical importance. So let's put them in motion. Let's offer them to investors. The goal is not just to get a publication in some academic journal. The goal is to impact the practice of management. The goal is to improve the experience of the investor. So I'm not the type of person that just wants to check the academic box of getting a publication. That's not good enough for me. And when I was offered the opportunity to put some of my research ideas to work with research affiliates in Goldman Sachs, yeah, I'm on board.
As you look into the I mean, the interest rate environment, it is favorable for the vehicles of fixed index annuities at the moment. And even if it wasn't, we've seen those products still become very successful as an alternative for customers for downside protection, as you already mentioned earlier. For like the advisors that are listening to this, what has some of your research shown to from reallocation and rebalancing? So I know you've done a lot of research and diving into pensions. You've dove into specific topics that you've done white papers on, and academic studies around just an advisor who might be listening to this. Is there a more efficient way? Is it quarterly? Is it monthly? Is it like how often should people be looking to rebalance as based off your research?
Let me just preface this, just going back to the FIA, that the product that we put together is dynamic. So it's not just dynamic in terms of allocation between value and growth. It is dynamic in other respects. In particular, there could be a situation where both value and growth are doing poorly. So you need some other dynamics. And this is what we worked on, having other possibilities. So we've got a dynamic bond allocation, we've got dynamic commodity allocation, and then we've got dynamics going across the equity, the commodities, the fixed income, with the focus on uh, on growth in terms of equity.
Mhm.
So so when you talk about rebalancing, that's exactly what the FIA product does, and it does it in a very smart way, in my opinion. So rebalancing in general is something that I've studied for years. And rebalancing is an active strategy. So if you think about rebalancing, let's say a 60-40 equity fixed income portfolio, um, if equity drops and you need to buy, so that is you're buying when the prices go down, and when prices go up, you're selling. That's an active strategy to rebalance. So my academic research details the impact of mechanical rebalancing schemes, mainly by giant pensions and target date funds. And this is the problem. So there's two types of rebalancing. One is a regular calendar-based rebalancing. Let's say at the end of the quarter, you rebalance to your target. And the other is a threshold base. So if you're like 3% from your target, you rebalance to the target. So that could happen at any time, not necessarily the end of the quarter. The problem with these rules is that they are mechanical. And if you've got these giant pension plans where in their public policy, it says, well, we're going to rebalance the last day of the quarter, then smart investors, they can see that's happening. So they know the pension, let's say, is going to buy at the end of the quarter. And what do? They buy beforehand and front run. So we know this is a problem because we convened a roundtable with a dozen or so major pensions, and we described this problem, and it was agreed that they already knew about this problem, that the mechanical rebalancing rules cause this drag on performance. They know they're being front run. And the research paper is called The Unintended Consequences of Rebalancing. And I think it's the first paper that I've written that was featured in the Financial Times 3 times in 1 month. So this has really got the attention of many investors and the media and the regulators for some of these pensions, because the bottom line is that this takes away from whatever a pensioner will get. So rebalancing, even though people just think that it's such a standard thing. It's like diversification. We think we understand that. We think we understand rebalancing. No. So I think that for investors in general, given that we've got these giant rebalancings happening from pensions and target date funds, that you need to be careful when you actually do your rebalancing. So our paper suggests that it's far better, instead of going the last day of the month to do a rebalance, to just randomly pick a day within the month. So you're not caught up in all of the noise that's going on at the end of the quarter or end of the month. So something as simple as that can lead to improved performance. So again, this is if you've got a fixed rule and kind of like boundaries on your portfolio. Don't do this the last day of the month or the last day of the quarter, because that could be potentially costly. If you've got a system like our FIA system, that's not going to be doing all its rebalancing the last day of the month or a quarter. It's more dynamic. So again, rebalancing is something that is largely overlooked, and I think it's low-hanging fruit where portfolio performance could be increased.
Start the year off strong with Prosperity Life. Now and throughout Q1, all Path Pro Series applications receive an extra 50 basis points in compensation. That's 7.5% on the 10-year with up to 1.75% in enhanced commissions. That gets you to 9.25% all in. A-excellent rated with Path Pro Max offering a 16% premium bonus and no fees. Power up with Prosperity Life and visit www.prosperitylifearc.com. That's prosperitylifearc.com. Especially in the field of fixed index annuities now, there's, I think, approaching 300 now of these what we call volatility controlled indexes. So these indices that are in this space, a lot of them might be monthly, a lot of them might be rebalancing quarterly. Some are now starting to do daily. And to my knowledge, yours, I believe, does weekly, if I'm not mistaken.
It's a staggered rebalancing.
Mm-hmm.
So we directly learned from my research.
That's interesting. So it's not a specific date. It's actually, and it's flexible. Wow. Okay. Use the word dynamic. That sounds pretty dynamic. um, but I think going back to also the pension topic that you were talking about, that is kind of interesting that they're very well aware, but they're not doing anything about it. And the fact that you're publishing or your paper was published multiple different places. And that goes back to the conversation of the number one fear of people in retirement is running out of money. So I think that's probably why a lot of outlets would like to pick up more information around topics like that, because that's, I would say, very familiar for people that are living in America and trying to retire and spend time doing things that they like to do.
Yeah, and it's also the case that if you've got a longer horizon, so if you're just starting out and you're thinking of retiring in, I don't know, 20 years or even longer, that these small things compound into something big when you retire. So to pick up a few basis points here or there, it might not seem like a big deal at the time, but in the end, it is a big deal. So this means that investors should look for product that takes all of these things into account to try to maximize the experience for the investor. And though it might seem like a small gain over any 1 year, what counts is what happens later after many years.
And I appreciate your time. And I know one of the questions I definitely wanted to make sure I asked you, based off of your research and especially being, I would say, the godfather of talking about inverted yield curves. And I feel like over the last several years, of 2, 3, 4, 5 years now, inverted yield curve is just a topic that the media picks up on and talks about. So as someone who's long discussed the importance of yield curve signals, what is the yield curve telling us today about potential recession or resilience heading into late 2026?
Yeah, so great question. And we are seeing the yield curve steepen, and that's mainly driven by kind of the part of the yield curve that the Fed does not control, and that is the long rate. And this is important. People believe that the Fed controls interest rates. Really, their maximum influence is on the short end. So with the short end going down, that leads to a steepening of the yield curve, but it can also steepen if the long rates go up. And I think that there's reason to believe that long rates are headed up. And let me go through a few reasons. So one kind of links to the beginning of our conversation, that people are worried about the US situation. So there's uncertainty. And many central banks around the world are heavily undiversified. They hold US dollar assets. And they're thinking of diversifying, which means dumping some of the US dollar assets and buying something else. And that might be gold. But when you sell those US bonds, that leads to the prices going down and rates going up. I also think that we're moving into a period of less trade. And when there's less trade, there's less dollars floating around. And that means less demand for US treasuries. Of course, the central banks don't hold cash. They take the cash and invest in something. And often that is treasury bonds. Number four, I believe that inflation expectations are resetting. So we are used to this 2% target. We've been above the 2% for an extended period of time. Mm-hmm. And people are thinking, well, maybe it's not a 2% target. Maybe it's a 3% target. And that manifests itself directly in the bond yields. Number four is something that will happen in the future. And we also kind of talked about the impact of AI on productivity. But what is less appreciated is AI is a great force of deglobalization. So what do I mean by that? Well, currently clothing is one of the main producers is Vietnam. I just throw out one country. And largely because the wages that they pay are very low. And we don't have that much clothing manufacturing in the US. But in the future, we will have manufacturing in the US. And that manufacturing will be done by humanoid robots. And those robots will be working 24/7 for $1 an hour wage. $1 an hour. So there's no reason to contract out to another country to do this job when you can do it domestically. So that's what I mean. AI will lead to very significant deglobalization and indeed pressure on many emerging markets that have a competitive advantage today because their labor is cheap. Well, the robots are cheaper. So this deglobalization, again, less trade, less demand for US dollars, and then fewer buyers of treasuries. Number six is the last reason, and this is, of course, linked to the economic model behind my yield curve framework, and that is higher US growth. So when we see growth accelerate, then it's often the case that rates go up. And that's a good thing. So you can think of the interest rate as a component that is purely due to inflation expectations. And then there's a real component. That real component is influenced by growth. And I do believe that we are headed to a period of accelerated growth. And the US is in a very favorable position. I thought by now other countries would fill the gap on innovation, and we'd have a major innovation that began outside the US. But that's not the case. So today we've got three technological innovations happening at the same time. And historically, I don't know of any period like this period. So the innovations are decentralized technologies, and that's everything crypto. So think of stablecoins as the killer app example right now, where you can transfer anywhere in the world within 1 to 12 seconds for less than 10 cents in arbitrary amount. It's transparent, it's secure, it disrupts the financial system in a very positive way. And it allows for things to happen that couldn't happen before at a very low cost. And it's very, very positive for economic growth. And number two, we've talked about already, That's AI. And we've not seen the benefit yet. And yes, there could be some correction in the price of some of these stocks, but this is not going away. And it has vast capabilities of increasing productivity. There will be many, many winners. And the US is the main winner because that's where the innovation is happening, both in decentralized technologies, in AI. And then number three is quantum computing. Gets less attention, but it is a very, very big deal. Where's the innovation based? In the US. So the US has housed these three remarkable innovations at the same time. And I said that, well, certain countries, certain emerging markets are going to struggle with, in particular, AI. Well, the US is in a good position because the companies are based in the US, so the US will benefit. Will there be displacement? Yes, but it's mainly in the form of reduced work hours. That's the way I look at it. So we've gone from 125 years ago, people worked 70 hours a week. Today, we're less than 35. So we'll just work less because we'll be much more productive. So I see this as a historicalist situation where everything is coming together. Innovation, and we continue to spend on innovation. It is remarkable how much the US spends on research and development. They spend much more than Europe, when Europe is larger than the US. So we are investing for the future. And if we can get that economic growth accelerated, if we can have ambition, and I think we've lacked ambition for many years, if we can have that ambition to put our fiscal house in order, there's obviously risk. And if investors embrace products that are not just the easiest thing to invest in, like a cap-weighted portfolio, but products that are able to pivot, just like industries are pivoting. So with dynamics, I think that the outlook is very positive.
Cam, you make me want to run through a wall. Yeah, it sounds pretty optimistic, especially those three. I mean, I know nothing about quantum computing, so I'm putting that on the the itinerary to understand more about that. But I think you're absolutely true with the decentralization. I have never thought of that as an opportunity for all the clothing's company is just one example. That is very wise. As we wrap up, any last words or thoughts as we're closing out here?
I would like to say that people, when they hear me say, well, he's very optimistic. And that's not the way I look at it. So I am a scientist. I look at the data and I draw a conclusion. So I consider this logical, reasonable, and realistic. So I do think that things are in a good spot. Yes, there are risks. And indeed, the US historically has been willing to take risks. Not everything works out. And when you fail, you pivot and you learn from it. So that is the mentality today of US industry. And I think that is the winning combination. So you take that risk. If you don't take the risk, then you can never realize the big upside. And the US propensity to take that risk is rivaled by no country in the world. So I do think that the outlook is favorable. However, we need to be careful to manage, in particular, the government side of this, because we're in a situation of considerable imbalance right now. So I hope that we can make some progress in 2026 to put our fiscal house in order.
Couldn't agree more. Thank you. Thank you for your time, and thank you, Cam, and thank you for the listener for tuning in. Hopefully you learned a thing or two. Make sure to subscribe on your favorite listening device to the Advisor Mentorship Podcast. Subscribe to our YouTube channel at Jeremy Hauser AMP, and connect with us on LinkedIn. And remember, when you share this episode with a friend or a colleague in a world full of betas, be an alpha.